Hey guys, Corey with Investor Life. And at Investor Life, we help newbies and seasoned investors like you to be able to scale your portfolio without using your own money. In today's episode, we're going to be talking about something that's really important when it comes to real estate investment, and that is monthly cash flow. In order for us to hold a property long term or to be able to keep it for years at a time, maybe even 5, 10, 15, 20 years, we need that property to be able to self-sustain itself. So what we mean by that is it has to be able to cover its own expenses. We don't want to have to be taking money out of our pocket every single month to help to pay for the mortgage or the taxes or the insurance or whatever expenses we might have on it. We want our income from that property to be able to cover all the expenses and hopefully put extra money in our pockets. And that's what we call monthly cash flow. So we're going to spend just a couple of minutes going over the monthly cash flow calculation. How do we figure it out when it comes to a property? What are some of the expenses and the income sources we want to consider? And that's our discussion today in this episode. So I'm going to share my screen with you and we're going to look at our property analyzer form. And when we look at that, hopefully you'll be able to see what we're talking about and how we can calculate this and make sure we're not missing anything when it comes to our income or our expenses. So here we go, guys. This is our property analyzer form. And again, if you want more detail, that's a different video. Today, we're focusing on this top section here, which is our monthly cash flow breakdown. And we're going to come up with what our monthly cash flow number is going to be. So the first thing we need to know is an accurate number when it comes to our income for this property. What is it going to rent for on a monthly basis? Let's assume, and let's just start throwing some numbers in here. Let's assume because we've done our research, we understand that this property we're thinking of buying is going to rent for $3,000 a month. Now that could be broken up into many different costs. Maybe, for example, we have $2,000 for our main suite. We have a basement suite, which is another $1,000. And let's say we rent out a garage or we rent out parking pads, or we might rent out storage, whatever it might be. We might have other income sources, maybe laundry, whatever it might be. So you can throw in some other costs here if you determine ahead of time that that's what you'll be able to get. So that's the income side of things, fairly straightforward, although we want to have accurate numbers. When it comes to our expenses, we need to be very sure on what those are going to be if we were to buy a property. So the mortgage payment, to figure that out, obviously that's based on our mortgage value. It's based on the interest rate we might be paying, the amortization schedule. All of those things will determine what our mortgage payment is. So we have to know what that is ahead of time. Let's assume in this example, our mortgage payment is going to be somewhere around $1,850 a month. Now, our taxes, that's another property tax is another expense you have to take into account no matter what. Every single property out there in Canada has property taxes attached to it. So let's make the assumption here that that's going to be $150 a month we're putting aside for property taxes. Insurance, we have to have insurance, especially if we have a mortgage on that property. We have to have the property insured. The mortgage company will ensure that we have it insured. And so we're going to have a cost when it comes to our insurance as well. So we want to account for that. Some other expenses we might have are utilities. Maybe we pay for the utilities and the tenants it's included in their rent. Depending on what province you're in, you might have to determine how you're doing that. I'm going to leave that blank because here in Alberta, the utilities is something that in most cases the tenant pays for on their own. So I'm going to leave that one blank, but it's something you have to account for if you are paying utilities and collecting that from your tenants instead. Property management costs, that can vary anywhere from 6% I've seen as low as up to 15, even 20% of your gross rent. Some property management companies charge a flat fee. They might have other fees for finding tenants, placing tenants, running applications, all of those sorts of things. So be sure what that's going to be for you when it comes to making these determinations. I'm going to use a round number for this calculation of approximately $300 a month, which is 10% of the gross rent. Repairs and maintenance, we all would love a property that never needs any repairs or never needs any maintenance, but we know that that's not true. There's wear and tear. We need to do paint jobs. We need to do those sorts of things. So we want to put a little bit of money aside every single month for these expenses to be covered. depending on the age of the property, depending on a lot of different factors, you want to consider ahead of time, what am I going to put aside to cover my repairs and maintenance? 5% would be an average number for most properties, I would say. But again, if it's older, this would be higher. If it's a newer property, maybe you have warranty on your appliances and on your home, then maybe this could be lower. But we're going to account for 5% in this calculation. Vacancy rate. What's the vacancy rate for the area that you are looking to buy in? Of course, that's a factor as well. Let's use a number of 5% for this illustration, and that's $150 a month. What other expenses could you have? You could have condo fees. You could have homeowner association fees. You could have lots of different, maybe you have snow clearing if your tenants aren't taking care of that, maybe lawn maintenance. There's lots of other things that you want to consider. Are these responsibilities I'm passing on to the tenant to take care of? Or am I going to need to hire a company to do these things for me? And so if you're going to be hiring a company, these are expenses you want to include in your calculation. So this is a quick rundown of what monthly cash flow is, guys. That's the purpose of this video. So in this case, do we cash flow on this property? Well, using the costs that we have accounted for and the income that we are counting on, it looks as though this property is going to cash flow approximately $250 a month, which works out to about $3,000 a year. Now, we need to know this number ahead of time, because if we don't know this number ahead of time, perhaps we could end up buying a property that is cash flow negative, which means money would come out of our bank account, out of our pockets every single month. We want a property that's going to put money into our pockets every single month. And that's what we call cash flow. So guys, it comes down to analyzing properties correctly. It comes down to being conservative on our income numbers, and also being conservative when it comes to our expenses, making sure that we are covering all of them. We're including all the expenses we're going to have, so that we have a clear picture of how well this property is going to perform for us for the amount of time it's going to be in our portfolio. So guys, a quick rundown on how cash flow works. Hopefully this is helpful, and we'll see you in the next video.